Yeah, good evening, guys. How you doing? You guys are doing well today. So we're gonna be talking about just a continuation for the inducement explanation that we did a schematic for it. So today I'm actually gonna be speaking on live market, looking at volatility. Doesn't really matter what chart you actually look at. Could be fixed, could be forex. You can find institutional liquidity or structure showing this institutional liquidity literally anywhere. All right. So in our explanation today, we're looking at the 24-hour time frame, or in reference the 1 day time frame. And what we can see here, we had a previous lower low, because this is a bearish market, which is validated by the previous breaker structure that we had, right? So this is a bearish market. That's the bearish external bias of the market, right? And here we have an inducement that I just identified. And like we explained in the previous video, an inducement is denoted by the market creating an area where both sellers and buyers are induced into the action of both buying and selling in the same exact location, right? And both of them get stopped out. So at this leg of the market, buyers were expecting the market to buy to higher prices. So there were some traders that possibly was looking at specifically this area here, right, as a reversal. So they were possibly looking for buys on the lower time frame, because you do have schematics like that that do create the idea of the reversal in these lower time frame market. But we're only going to be able to see the real setup based on momentum and price with the body of the candles. And the body of the candles here would actually show us that we have a lot of money in the market. So at this specific area, matter of fact, we are not even seeing any major pushes. So I would consider this here as a consolidation, right? Okay, so at this area, retail buyers were looking for buys, right? And at this area, there were retail sellers thinking of the idea that the market is going to sell for long, and possibly were aiming for extended lower prices, right? So what happened is we do have stop losses here and we have stop losses here. So the market buys here, buyers are expecting to go long, and the market drops and take out the stop losses under here, right? Under this area. And we have sellers thinking to go long, right? And they enter with their stop losses above this area, thinking that the market is going to drop and keep dropping for a long time, right? So that's what happens. And then the market pulls back, takes out the stop losses, the entries, the stops, it doesn't matter, all of that get taken out. So both of this area here is the exact area that we're talking about. This is the area that's called the trap, right? So we want to focus on that for a minute. So what we have to keep in mind is the market only takes out inducement to move. We have liquidity, and inducement is also liquidity, but it's called institutional liquidity. So the market has to take it. It's basically the power of the market. We have fair value gaps, we have equal lows, but this is the main liquidation that the market has to take before it decides it's going to go in a different direction. So once it take this out, it's going. It's going to take this out. It's going to react in premium at an area of premium price. Let's just use our Fibonacci retracement from this high here to this low here. And we're going to see that the 0.786 or the 7860 level is the trap zone. That's normally where the market goes to sweep out all the liquidities. That's normally where it goes to sweep out the traps, right? So once the market hits this area, it's going to be taking out all the traps, all the fair value gaps, and it's going to tap into that extreme premium area of supply so it can continue in its direction. And once the supply is taken out in premium, we know for sure that it's going for the next break of structure, which is this low, which would be our target, right? So we got to take we got to take that into consideration every time we look at the market. That's what it's looking for. It's looking for the main inducement, right? What we see here before the inducement was casted, we're seeing that the market had a higher high, the extreme high that we're looking at, and we have the low point right here. These are the external points, right? And we're seeing that the market had selling momentum dropping from this area, which failed to take out the low in one fell swing. And we see that it pulled back. And remember, at this point, retailers were looking for buys and sells. So the bias for some traders were for buys. They were not aiming for, going on, for forever and beyond. They were possibly aiming for these highs right here, right? Definitely. They were possibly thinking that we got a sweep of liquidity, a reversal, and we are aiming to take out these highs. And halfway at the 50%, they're seeing a descent, and they're possibly thinking, let me keep holding it. Maybe it's gonna be reacting off this block here, and let's mark this area as a liquidity and wait for it. And we both can see what happened, right? So we got to be mindful that what we look at mainly, we're not going to be looking at internal structure. Internal structure is not important. What we always focus on, we're always going to be focusing on the external swing points because these are our guides. These are what let us know the directional bias of the market at all times. Okay? We need to focus on that. All right? So the trap gets sweeps out. Market pulls back within this high and this low, this range into premium, which is, as we know, above the 50%. So above this 50% area here, above this 50, anything above the 50, the 61.8, the 78.60, this area here is what we consider to be the premium zone of price, right? Because we are only going to be selling price when price is at the premium range, and we only buy price when price is in discount, right? Just like supply and demand. All right. So after taking out the inducement, the market proceeds to fall. It falls from this high here, fails to take out the low in one fell sweep, and it proceeds to pull back, right? And then it falls from this area of supply and it breaks the low. It gives us a break. And that signifies to us that this high, even though it's the external swing point, it's not the strongest. The market had to come here so early sellers could tap in, and early sellers actually put their their stop losses here, expecting that the market is going to go along. So after we got that break here, they were possibly expecting that the market is going to definitely continue all the way to the downside. But that is actually an inducement because they're induced to think that the market is going to continue selling from here. And we're saying that the market pull back. And once it pulls back, it's for a reason. Because if it was gonna do the final sell, if it's gonna do it, it's just gonna do it in one fell swoop. There's no need to go and break and then pull back. So it means that it's doing something or it's aiming for something to take out something so it can move to the downside, right? Okay. So this high is the inducement. This is the area that was induced to cause this break, right? It failed to follow through completely. The market pulled back again and it fell. And what we're expecting the main break to happen. We're expecting to have that main break of structure. So the market is going to finally give us the main break or the significant break that we're looking for. And once we get that significant break of structure, now we can look for the pullback, which is the correctional pullback that should be pulling back to take out both of these inducement highs. We got the break here, and the market seems to be giving us another break of structure again. Because once we get a break from an area of early sellers in the market, what should have happened? We should have had the break and then the pullback to sweep out the early sellers here, and then we get the real sell movement to the downside. But we never got that. What we got instead was we got a break of this low, a pullback, and we're now going to get a next break. So what that means that we have two areas, this inducement that wasn't sweep, which is liquidity also, and we also have this high that was not sweep, which is also liquidity. And once the market breaks this low, we're expecting it to turn back and target both of these highs. You can call it relative equal highs, you can call it equal highs, you can call it inducement, whatever. This is the significant institutional liquidity that the market is looking for right now to take out so it can continue in the direction that it's going. And you may be wondering, why are we on the 24-hour time frame? It doesn't matter what time frame you're on. If you're able to look at market structure, it's the same thing that happens on all time frames going all the way down, right? So I would possibly refine my trade once the market breaks this zone, heads here, and maybe I would enter in on a reversal somewhere here in this region. When it's pulling back, I would look for a reversal setup. And that reversal setup, let me just draw you a schematic. It would look something like so a descent, we got a pullback that causes a break of structure here. And we have a descent back here. We got a major break of structure. That major break of structure that swept the inducement here is validated as a valid swing point. And now, since this is a valid swing point and this is a valid break, we are looking to shift back, breaking this high, right? Hold on. So we're expecting to shift back here, breaking this area or this high. Let me just delete this. Breaking this high as a change of our market structure shift. So this would have been an inducement, and we would have had an area of an order block, a bearish order block right there that it would have respected. And this would have been an internal area that broke. But the major, remember that pullbacks are validated by inducement, right? So once the market reaches this point, pulls back and sweep this high, because what that would have mean, what that would have meant would have meant that this minor pullback that we had never swept an inducement. So it's liquidity, right? It's a standalone liquidity. And since this area or this pullback high never took out any inducement, because the inducement that would have been valid for it to take out would have been the high previously, which is the high that we marked as the area of supply. And if that high was taken out, then there would have been no need for the market to pull all the way back here, right? If you understand what I'm saying. Anyways, so this would have been the area or the high that gets swept. This would have been the area of supply. Hold on. Pull this up. Should look something like this. Yes, let me give it a little bit more concept. Yeah, so this would have been the breakup structure. For real, thinking about it, you should see a lot of this on the market. So it would look something like that because this would have been the high that caused this major breakup structure, right? And this would have been the extreme swing point right here, or the major swing point. So let me put this here. This would have been the breakup structure right there, or the change of the market structure shift, MSS. Let's put that there. Yeah, that would have been the market structure shift that we got. And let me pull this back a bit. This would have been an area, because mind you, this would have still, before we got this market structure shift, before the market give us this bullish push, sellers would still be thinking that the market may go lower. So they would be thinking that, hey, let me look at this area here as an area of supply and let me set my entry right here, and stop loss is above this high here. So let me just take an entry and aim for the break of structure there. So that's what they would be thinking once the market drops all the way down here and pull back here. So they would be thinking that, let me take an entry here, and this would have been the schematic, and that's how they would get caught up in uh becoming liquidated and falling for the trap, because you don't buy once the market pull back to an area of discount. This low, or this break, once it breaks down from break of structure, once it breaks this threshold, anything below this zone, you should not be looking to continue selling. You should have entered the sell from above the break of structure. Enter here for the sell, enter here for the sell, enter here for the seller, enter here for the sell. Once it breaks and gives you that break, you have missed your entry, the prime space of entry. Now you're in an extreme risk area, right? And that's how a lot of retailers get caught up and get trapped. So they would have fell for that. A lot of people would have fell for that, honestly, right? So this would have been a market structure shift. And looking at the same concept, just like we have this high point that caused the shift or the breakup structure, while we have the extreme high point here, which is denoted as the market structure shift. It's the same thing. We have a pullback that failed to take out the market structure shift. At once, we have a minor pullback, and then we have a push here that breaks the the market structure, or gives us the market structure. So this would have been our area of inducement, our trap, because here, like I said, sellers will be looking to take an entry, thinking that the market is going to continue to break lows. And also buyers would have been entering, thinking that they should be catching the buys early, and they would be thinking that this would have been a demand zone. So the market would pull back here and push to the upside, right? But remember, market only pushes after it has taken out institutional liquidity. So what would happen is, we would need to get a pullback down in this region, and then we would have to look for a reversal in a here, or a minor reversal on the 1 minute, 5 minute time frame. It doesn't matter. And we would have a demand zone right here. Once the market takes out this inducement, then you just look for your opportunity and take an entry, and you would be aiming for the next major breakup structure, or I should say, you could possibly aim for the next area of liquidity. Doesn't even matter. I, for one, possibly would definitely be aiming for uh the pullback here. I'll be aiming for these areas of liquidity, because remember that I said that on the higher time frame of this market, or this asset, it's an overall bearish market. So I would definitely be targeting these highs, right? These areas of inducements. That would have been my target. So after hitting here, that's what I would be, aiming for, essentially. All right. I hope this video and the previous one has also been helpful to you guys. And if needed, leave a comment. And I do expect you guys to support my channel. Do leave a subscription Leave a like, leave a comment, share the video, share it amongst friends and family, loved ones. It doesn't matter. I really appreciate the support, and hoping my channel can grow a bit more. Thank you so much. And if you want to see more videos like this, go right ahead and hit that subscription button.